Hello everyone, today's video is all about employee ownership trusts. Now what prompted me to make this video was something that was in the news yesterday. Sad news really about John Lewis, which has said that they will not be reopening another 8 of their department stores. And it got me thinking about the John Lewis model, the business model, which they are relatively well known for, the so-called employee ownership model. And for decades, in fact over 100 years, John Lewis has been owned in such a way that all the employees do have a stake in the business. And got me thinking about what if other businesses adopted the so-called John Lewis model. Now, this was made a lot easier for businesses to adopt a similar business model, ownership structure, in 2014 by George Osborne, when he brought in the new rules that I'm about to tell you about for selling a business to an employee ownership trust. Now, this is a good way for a business owner to offload their company. So let's say you're an SME entrepreneur, you own a business, trading company, you've had it for several years and you want to sell. It's time to exit and you can't find a trade buyer. Or maybe you could find a trade buyer, but then let's talk through the tax consequences. So you sell shares in your company and let's say you qualify for entrepreneur's relief. Well, entrepreneur's relief is pretty good. It's 10%. It's not as good as it once was because it's 10% on the first £1 million of gains, where it used to be 10% on the first 10 million of gains. So anything that you make when you sell your business and anything over £1 million that you sell it for, you're going to be paying tax at 20% capital gains tax, not 10%. It's only the first million that qualifies for this entrepreneur's relief at 10%. So what if instead you didn't sell it to a third party, but you sold it to an employee ownership trust? Now, the employee ownership trust rules were brought in to encourage more and more businesses to be like John Lewis and to have collective ownership, which hopefully would drive the business forward. Now, how it would work from a seller's point of view is that the seller would sell the shares to this trust on an IOU basis. So the trust is set up and it owes money to the seller. Now, the beauty of this is that the rate of tax is 0%. It's not 10%, it's not 20%, it's 0%, no matter what size the proceeds are going to be. It doesn't matter if it's over $1 million or 10 million, regardless, you're paying tax at 0%. Which is terrific from the vendor's point of view. So you can't get any better tax than 0%. So how do they get the money? Well, they sell the shares to the EOT, the Employee Ownership Trust. But the Employee Ownership Trust doesn't have any money, so it's an IOU. And what happens is that each year, for the next however many years, the company continues to make profits, pays its corporation tax as normal, then the post-tax profits that are in the company, they get paid out to the trust, and then the trust repays the IOU to the vendor, and that money is tax-free. So let's take an example. You've got a vendor sells shares for 10 million, and you get the company all valued, professional valuation done, and you say, right, it's worth 10 million quid. So, and let's say the company is making over £1 million a year profit. So what happens is the legalities are done and the paperwork to transfer ownership of the shares from the individual to the trust. And there's a legally binding IOU. And then after year one, company net of corporation tax, there's £1 million left. That gets paid up to the trust, repays some of the IOU. Next year, same again. And you can see after 10 years, the vendor has received his £10 million all tax-free. Now, it could be, depending on the size of the deal, that payout is less. It could be over 5 years, could be over 3 years. It all depends on how much A, the business is worth, and B, how much the business makes in profits every year to be able to afford to pay out the vendor. Now, from the vendor's point of view, they can stick around and even run the business for those few years to ensure that it's making enough profits to then repay the loan to them. They're not allowed to be shareholders because remember they've sold out to the trust, but they can still be directors and an employee of the business, because the last thing that the vendor wants is that they've sold this valuable business to a trust on an IOU, and then they don't stick around, and unfortunately whoever's left to run the business run it into the ground, and then the vendor doesn't get the money, and the IOU promise is worth next to nothing because there's no money to pay it. So from the vendor's point of view, they can hang around, make sure the business still does really well, as successfully as it was when they both were running it and owned it, to make sure that there's enough profits to then pay them out for however many years it takes to repay that IOU to them. So terrific for the vendor from a tax point of view. Like I said, you can't get better than 0% tax. Yes, they may have to hang around a few years, but that tends to happen anyway. Commercially, when you're doing trade sales, often the buyer will say, we want the main person to stick around for a few years. So, and you can still pay themselves a decent salary, even though they're not going to be a shareholder. They could pay a wage commensurate with being the managing director. So from an employee's point of view, the employees technically then are beneficiaries of this trust, so they all have a stake in the business, and they're also allowed to have additional tax-free bonuses every year, 3,600. So let's say you got an employee, and before the deal to sell the company to the trust, they were on 30 grand a year salary. Going forward, they can still be on that 30 grand a year salary plus 3,600 income tax-free bonus. So that's the appeal for the employees, that all of a sudden the company that they work for has changed hands and it's now owned by an employee ownership trust, and they get they're going to benefit from this extra salary that they can get tax-free. So it's kind of a win-win situation. There's all sorts of incentives for the vendor, and there's incentives for the members of staff who are now working for a firm which is being run by a trust for their behalf, and they get these tax-free bonuses. So just something to consider if you are a business owner and you're looking to exit. So when you have to weigh up your options, there's all sorts of things you could think about. It could be a buyback of own shares from the business. It could be a third-party sale. But remember, with Entrepreneurs Relief not being as generous as it once was, you only get 10% on the first million. Now, that might be great for, I'm sure it is great for many businesses where, a seven-figure sum is terrific. But for those, who potentially could get several £1 million for their business, then, it's a big jump in tax. It's doubled from 10% to 20%. So an employee ownership trust could be something to think about, because you cannot get better than 0% capital gains tax. And that is what is afforded to sales done via the EOT method. So business owners, just something to think about. One eye on exit, or if it's imminent, think about it. Do think about it seriously. But selling your company to an employee ownership trust, the so-called John Lewis model, lots of tax benefits for doing so. Principally 0% capital gains tax. So that's just a quick overview on EOTs and how you can offload your business to one. If you like this video, please do subscribe there, and I will see you soon.